Hello, Neil here. Today I wanted to talk about the real estate professional tax election that allows real estate professionals, those who work in the real estate trades or businesses or the investing and management of real property. It allows them the opportunity to recharacterize passive income into ordinary income and passive losses into ordinary losses. And that's the key piece that makes investing in real estate and leveraging the real estate professional election really powerful for those that are able to take advantage of it. What is a real estate professional? A real estate professional is someone who spends significant time working in real property, trades, or businesses as defined by the IRS. What is passive income and non-passive income? Passive income are those types of income that generally the investor or the taxpayer doesn't spend a lot of active hours working to generate that income. To not get too far in the weeds, rental income is generally a pretty well understood source of passive income, because though you may place tenants and you may do a little work between tenants, for the most part, the asset is what is making the investor or the taxpayer money in that case. Whereas non-passive income are those incomes that a person materially participates in generating. So the most common source of non-passive income for U.S. taxpayers is a job where you receive a W-2 at the end of the year for the services you provided to an employer. Other sources of non-passive income may be the self-employed individuals. They own their own business. They actively participate in the business and they meet those material participation qualifications. The way a normal taxpayer handles differentiating between their ordinary income on their tax return and their passive income on their tax return, as well as their ordinary losses and their passive losses, is that passive income and passive losses can only offset one another. And this happens on a separate form in your tax return where all sources of passive income are identified. And if you have passive losses available, you're able to offset that passive income. And the net of those two is what comes forward onto your Form 1040 or your individual tax return. So what real estate investors are looking for are ways to bridge that characterization. Okay, before you get really excited and say, hey, I've got rentals and I'm involved in real estate and I materially participate in that real estate, I must be a real estate professional, sign me up. Unfortunately, it's not a low bar to hit. For some individuals, it may be a low bar to hit because of what they're doing in their day-to-day. So general contractors who are working full-time in the real estate profession, I think I mentioned earlier, real estate agents or brokers that are working full-time in the real estate industry. These individuals may easily pass the first bar, which is that you need to spend more than 50% of your total time in real estate. So if you're already spending most of your time in a real property trader business, as the IRS defines, the first part of the qualification that you must spend 50% or more of your total work time during the year on real property trades or businesses, that qualification is probably met. If you're doing other activities for gainful employment, you may be self-employed in a business that's not involved in real estate, you may have a day job, you still might be able to hit the greater than 50% of your total work time is in real property trades or businesses. But it generally would mean that you are working, 80 hours a day. And it's it's really frowned upon to push for this election if you are doing a whole lot of other stuff. I'll talk about later in this video about married couples and how utilizing a spouse or something and targeting this election may be a good strategy for you to pursue in the future. So 50% of your work time could be low if you're not working. So they have a second threshold that you must meet to qualify as a real estate professional, which is that you must work over 750 hours in real property trades or businesses where you materially participate. So you can't just own a bunch of real estate investments passively like REITs or limited partnership interests and say when you check the value of those on the markets or you read the investor statements from the limited partnerships that you've, spent 750 hours. They need to be hours that you're materially participating. So the management of real property trades or businesses. So back to being in a construction trade or a real estate broker, realtor role, or potentially the active management of a real estate portfolio. This election should not be elected lightly. There are lots of IRS court cases and decisions overturning taxpayers' elections because they fail one or both of these thresholds to qualify. They also fail to keep any kind of cursory logs, calendars, or credible records for each year they make this election. And so when they get to examination, they attempt to estimate or reconstruct their activities and usually fall short, or it's determined that they were nowhere near qualifying in the first place. So regardless of how attractive this election is, you really do need to hit the thresholds and be in a situation where you can document clearly that you're hitting those hours. And you need to be able to show that 50% of your time is in real property trades or businesses. Another idea that I just mentioned with that second threshold is that you need to materially participate. And material participation is not just a flippant term I'm throwing around here. It's actually a defined term by the IRS. And I believe there's 7 tests that you can use to demonstrate that you materially participate in an activity. Usually with real estate professionals, we're looking at grouping all of their real estate portfolio into one activity, because one of the thresholds, like the lowest threshold for material participation, is that you at least materially participate 100 hours. And most real estate investors aren't going to spend 100 hours on any one property, except maybe if they're rehabbing it themselves, it's going through serious repairs and maintenance, etc. And so generally, we're also, with the real estate professional election, discussing grouping the taxpayers' real property trades or businesses so that we can meet the material participation across many activities versus being left to show and demonstrate that we qualify for material participation on each individual activity. It's important to note that for married couples, the 750 hour test is for one person. You can't combine your hours spent and argue that rises to greater than 50% of one spouse's working time, and that rises to the 750 hour test. Now, there is one carve out where you are able to group spouse time, but it's important to understand that this is just for that material participation element. So the perfect example of this is you have one spouse that only works in real property trades or businesses, and they worked at least 750 hours in the year, and they did nothing else. that would mean that they spent greater than 50% of their working time in real property trades or businesses, and they got the 750-hour test. Now, the second piece of that I discussed was that you also have to be materially participating to accrue those hours. And though, with smaller real property trades or businesses, we're generally going to group them all to ever reach the material participation test. There may be some instances where we don't want to do that, and we still might be able to meet the material participation because both spouses spent time on a specific activity. I don't spend a lot of time sort of trying to parse this out with a spouse couple, but there may be some instances where you can reach material participation because both you and your spouse painted the place, and both you and your spouse listed the place, and both you and your spouse showed tenants. And so maybe on certain activities, we get to the material participation on that activity. But keep in mind, this doesn't hit the 750-hour element. It just means that we materially participate in an activity. All right. So why is making a real estate professional election so lucrative to those with real estate portfolios? Why would we go through the trouble of triggering this? So like I said in the beginning, when I was discussing ordinary income and passive income and ordinary losses and passive losses can only offset passive income. And generally early on when you're investing in real estate, you're leveraging the real estate, and so you have interest expense, which goes against the ability to have any kind of profit, and you have the ability to depreciate the improvements on that property. So the building, the sidewalks, the fences, the flooring, cabinetry, countertops, etc. You have the ability to depreciate that property, and that depreciation can also add to a low profit or no profit on rentals in early years. But for high earning individuals where you have, say, a married couple where the spouse makes $200,000-$300,000 a year, the real estate losses or the passive losses for that couple become suspended, and they're only able to offset potential rental income from other sources or passive income from other sources, which a lot of people don't have a ton of when they are first starting out and they choose rental real estate as their first investment. That's just your run of the mill, put a little money down, buy a house on debt, have depreciation, have initial expenses, maybe you have initial vacancies. It's really common to have some passive losses in early years on real estate. However, a shrewd investor will also ask to do something called a cost segregation study on their real property, which parses out the attributes of the improvements. So it finds 5-year depreciable property, 15-year depreciable property, and 27-year depreciable property. And the unique thing, at least right now, that's been going on for the last 10, 20 years in the tax code, and we've had all different levels, is that 5-year personal property and 15-year land improvements qualify for something known as bonus or accelerated depreciation, where you don't necessarily have to depreciate the entire amount over 5 years or 15 years, but you get to take the entire deduction in the first year. For tax years 2023, we were at 80% bonus depreciation, meaning you could take 80% of the costs that were attributable to the 5-year property and the 15-year property all in year one. And in 2024, we were down to 60% bonus depreciation. And in 2025, we're going to be down to 40% depreciation. However, we still were able to shift the depreciable lives of a lot of those improvements from 27 and a half years, meaning we would have taken the deductions over 27 and a half years. If through a cost segregation study, we're able to identify $100,000 as 5-year property, we get the privilege of expensing that property over only 5 years. With bonus accelerated depreciation, we get to take the 40% in 2025 all in year one, and then the remaining 60% will be depreciated over those 5 years. All this to say, with a cost segregation study and bonus accelerated depreciation, real estate investors can create lots of passive losses in year one of a real estate activity or a real estate investment. And so that doesn't necessarily do a whole lot for somebody who is not a real estate professional, because those real estate losses that have been created are going to be treated as passive. And only for a real estate investor that may not be a real estate professional, but perhaps this is their 5th or 6th rental, so they have positive rental income from their earlier investments, and so they're looking to doing these cost segregation studies and accelerated depreciation to help offset other rental income that they have in their investment portfolio. That works still. However, for somebody who's trying to shelter lots of their ordinary income, so those earned wages that they're having to pay maximum tax rates on potentially, the opportunity for a spouse or for somebody working in the real property trades or businesses field, there can be a real opportunity to go a step further and get to the real estate professional election, so that instead of sitting on these passive losses until these investments turn into profitable investments, you're able to actually bring those passive losses over to your ordinary income side of things and take full advantage of those deductions today. And why this becomes really lucrative is because you get to treat not only like the money you put down on a rental property to close on that rental property, so you're 20% down, but you also get to take deductions against your debt basis. So any kind of loans that you've taken out to purchase these properties, you're not limited to just the cash you invested. And so you can really compound the benefits of investing in real estate, not only from the sort of passive cash flows that come in from it and, decent returns, but you can get a 30%, depending on your tax rate, anywhere from a 30 to 47% tax cut against your ordinary income, which means more cash for the investor that they get to keep today and turn around and reinvest it in new projects. And if this is done smartly and continually, you really can kick the tax man problem down the street for years to come. So just to flesh this out with a really simple example, imagine we have spouse A that does a day job in education and makes $200,000. They're a professor or something like that. They make $200,000 ordinary wages. And then we have a second spouse who is a real estate agent and clearly meets 50% of their work time is in real property trades or businesses, and they clearly work over 750 hours. They materially participate in this activity. And they've also bought two rental properties for, say, $500,000 a piece. And after they talk to their CPA and they do a cost segregation study, they've identified about $100,000 of passive losses. Like after they bring in their rental incomes and they take their property tax expense, their interest expense, and the accelerated depreciation, they're sitting there with $100,000 passive loss. Because they're over $150,000 of AGI, they're not going to be able to use any of that passive loss against the professor's income, and it's just going to sit there. However, they've been planning with their CPA, and they fully intend to not only make the real estate professional election, but they're also going to group their rental activities together so that they clearly will meet the material participation test on their rentals as they are on their realtor activities. And by doing this, they're able to use those $100,000 of passive losses against the professor's ordinary income, which is going to reduce their taxable income from approximately $200,000 all the way down to $100,000. And in their tax rates, we'll say they're going to hypothetically save about 20% for federal and 10% for state. So a combined 30% tax rate on that $100,000 of savings means that they are going to spend $30,000 less in federal and state income taxes for the year, which could really tee them up to now invest in that third rental property. Had they not been able to make the real estate professional election, that $100,000 of passive losses would sit there. They wouldn't lose it, but it would just sit there, and you'd lose time value of money return on it, all that stuff. It would just sit there and be there for the next tax year to potentially offset actual passive income in tax years 2, 3, 4, and so on until it's fully utilized. By deferring taxes on rental income and shielding ordinary income, you can grow your portfolio faster. I need to mention short-term rentals for a moment here. There are some recent court decisions that are looking at your Airbnb, VRBO type activities, those rental activities that are generally less than 7 days to your tenants or guests, that they do not count towards your 750-hour requirement because they are more in line with hotel motel services, and those services are not one of the real property trades or businesses as defined by the IRS. And so if you're sitting on a bunch of VRBOs or Airbnb type activities and you're getting super excited about making this election is not for you. However, because those activities are looked at as hotel motel services, they don't necessarily fall into the passive loss category as swiftly because they are your more typical material participation trade or business. You may be getting to treat those as ordinary losses in the first place. I'm not really going to cover that here. I may make another video altogether about that, but just when you're thinking about your real trades or businesses, your real property trades or businesses, you need to be thinking about, and you're thinking about your rental activities, those need to be more your month-to-month or annual lease, residential or commercial type properties. Another risk with qualifying for this is the year you choose to do it. So if you're in year 5 of investing in your real estate and all you've had is losses and losses and losses, and you're now sitting on a large passive loss carryover, the year you make this election will not go back and recharacterize those passive losses from years 1 through 5. And it may park those losses in an unfavorable way, and where now your rentals may be throwing income, but instead of that income being passive income and being able to offset these suspended passive losses, you now have ordinary income because you're making the election of the real estate professional. So again, you shouldn't be doing this on your own. if you have a sizable portfolio, you're probably working with a tax professional, but it's really important to not only be looking at your current year, but to be looking back a few years and see what's there, and then also be looking forward to what's coming. I just want to take a moment. If you have been following along and liking this content, please take a moment to like and subscribe. Like the video, subscribe to the channel. Please feel free to put comments or questions in the comment section, and I do my best to reply to those. Being able to qualify as a real estate professional really is a powerful tax strategy, but it requires careful planning and documentation. If you think this could benefit you, talk to a CPA or a tax professional to see if you qualify and how to optimize your strategy. A couple other great benefits I didn't really discuss here, and they kind of get into the more nuanced side of taxes. But if you're a real estate professional, you generally also are not subject to net investment taxes on your real estate income. You also potentially have the opportunity to take advantage of other bonus depreciation code sections like Section 179. And so while I am in no way condoning that you stretch the truth to get to greater than 50% of your time as a real estate professional, or stretch that you're working at least 750 hours, I do see very often real estate investors that clearly meet these requirements. They're doing this every year of their lives, and there's really no extra effort. It's just there's a disconnect between how their tax returns being prepared and what opportunities are available for them. And it is just making this election and then making sure to recode the income in the tax software so that these things carry out from the passive income loss schedules and become treated as ordinary income and ordinary losses. So yeah, again, if you like the video, if you've got questions or comments, anything you can do, like, subscribe, leave a comment, encourages me to make more of these. And I really appreciate hearing the feedback. So again, Neil at Neil CPA, thanks for watching.